Um, what's a non-recourse mortgage? What's a recourse mortgage? How do you tell the difference? And what's the difference for tax reporting? That's sort of loaded.
Okay, well let's go through it. In general, and we're talking about homeowner situation here principally, although let's say 1 to 4 units of residential just for the sake of discussion. There's a rule in California called CCP 580B, which is a statute which designates certain loans as non-recourse. Generally speaking, and there's a few additional items, but generally speaking, the non-recourse loan is the loan that originates at the time of the purchase, and the loan proceeds are used partly or wholly to buy the property, and the property is occupied by the borrower. So those are the requirements. So I go out and buy a house, I put 20% down, I get an 80% loan. That loan is, and I live in it, and that loan is a non-recourse loan. So the only thing that can happen to me is if ultimately I don't pay, and let's say, for example, the loan amount's 80 and the property goes down to 20 in value, and I just stop paying and there's a foreclosure. There's a deficiency there, but by law the deficiency can't come back to haunt me personally. And that's what they mean by non-recourse. There's no recourse back to me.
So they can only look to the property for satisfaction of the mortgage.
Correct. Now, by contrast, a recourse loan is any other loan, for the most part. The loan that I just described is about the only non-recourse loan in California, truly. There's some commercial situations, I don't want to get into all that, but for homeowners, for 1 to 4 units. So a recourse loan is typically, it's a purchase money loan for an investment property. You know, I'm not living in there, but I'm buying it. So that's a recourse loan. It's a refi loan. This is where people get into trouble. I bought my house for 100. I got an 80 loan. I got another 80 loan, but I didn't take any money out. I just replaced the original loan. But it is, in fact, a refi loan.
Because people will remember they were trying to take advantage of lower interest
Correct.
rates.
So I had a 7% loan, and now it's a 5% loan, that kind of thing. So that's a recourse loan. So the upshot of that is that if there's a foreclosure, it's possible. Let's go back to my example. The house is worth 20. The loan is still at 80, so there's this deficiency of 60. And the lender says, you know I can get the house back, but I want to get something from the borrower personally as well. So for a recourse loan, there is an option for the lender, not taken often, but it's an option. They'll simply sue the lender or sue the borrower and say, I want the property and I want you to pay the other 60. And that's the importance of a recourse versus a non-recourse loan.
Okay.
Now you had a tax question in there.
Well, right. So what's the difference for tax reporting?
Right. So a non-recourse loan, if you truly have a non-recourse loan, when the foreclosure or the short sale happens, or let's call foreclosure, when the foreclosure happens, it's deemed as if the sales price is the amount of the loan. So let's go back to my example. I bought the house for 100. It went down to 20. There's an $80,000 loan on there. And when the foreclosure happens, it's $79,000 or something. So the $79,000 is considered the sales proceeds as if I sold it for that number. That's the non-recourse rule as well. Now, in addition to that, a recourse loan is not treated like that. So let's say I've got this property worth 20, and I've got an 80 recourse loan because I refied, I got a better interest rate and so forth. Now, a recourse loan creates something called cancellation of debt. In that example, I'm selling the property for 20 because that's what the property's worth, but this other 60 is considered ordinary income. That's canceled debt. That's ordinary income on top of whatever gain or loss you might have.
Mm-hmm.
The 60 can be taxable income or might not be, depending on a variety of other factors, which I'm sure you are thinking about asking me.
Okay, well, maybe we'll get into that now. So are all mortgages, okay, well, let's talk about the Mortgage Forgiveness Debt Relief Act of 2007.
Right, okay.
And has California conformed,
Yes.
and how does it work?
Right, okay. So let's talk about that example here where I bought a property, got an 80 loan, and then I refied the loan. For the federal law that you just described is something called 108A1E, because I talk in code. I'm sorry, just forevermore. So for property up through the end of 2012, if you have this circumstance and you have this 60, and the loan was used to buy the property or to improve the property, that debt is eligible for this exclusion. So the 60 is income, yes, but it's excluded from taxable income by this other provision.
Mm-hmm.
Now let's change the facts a little bit. Let's say that I got the 80 original loan, I refied for 80, and then a couple years later I said, well, I need more money, I'm going to refi for 120. And then I got whacked on foreclosure. So now I've got 100,000 of deficiency, 100,000 of cancellation of debt. Well, my first 60 is covered by the homeowner rule that we just mentioned. The other 40 is not.
Mm-hmm.
So it's typically, and what this boils down to is anybody that's taking cash out of their house for other purposes, they're not going to be covered by this 108A1E.
Mm-hmm.
And there may be some other rules that could help them, but it's not going to be helped by this homeowner loan acquisition rule.
No, and California has conformed.
California's conformed effective last April.
They
retroactively.
They did it right when, like, the filing deadline just drove everybody crazy.
April 13th.
Yeah, crazy. Now, let's see here. One thing that's important related to this is, when does this expire?
Yeah, so it's the end of 2012.
So we had it 2011 we're in right now, 2012 next year, and then
who
unless
knows?
Congress takes action, we're back to square one as far as these.
Correct. So that acquisition debt rule doesn't apply as well.
So hopefully they will do some sort of an extension, because it seems like they're taking quite a while to work through this thing.
Yeah, there's been some predictions, 2014, 2015, before we really get all this behind us.
Yeah. So I think, actually, we're getting close to running out of time here. And so I'm going to just throw it to you again to give some words of wisdom, or whatever, highlight maybe a final point that you want to make related to this.
Here's the key. If you have a house that you're going to try to exit, short sale and foreclosure are going to be the two ways you do it. Short sale can be good. Foreclosure is sort of the default. I think you need to understand the tax impact and the legal impact. I think some people think that if they have a foreclosure, it wipes out all the debts. It's not always true. I think some people think that when they go through a short sale, that somehow it's going to be a waiver of any claims against them. That's not necessarily true. I think you need independent legal review of all documents that you're signing, including listing agreements. You have to be concerned about, somebody who offers to buy the property. You need that reviewed by an attorney, because there's serious potential liability to the buyer. And by all means, read or have a lawyer read the short sale proposal that comes back from the lender, because those are real critical. Before any of that happens, you really need independent advice, because there's a lot of different collateral effects here and so forth.
Okay, Scott. Well, thank you. Thank you for being my guest today. We're both pooped. It's October. It's going to be April 19th.
One of those days, yeah.
Yeah, right after the 18th, which was a filing date. And anyway, but folks, this is just a really critical area. A lot of people are having difficulty here, and so get good advice, I guess, is the bottom line. This is just, again, a starting point. See you next time on Financial Insider Weekly.